If you've paid any attention to the Amazon Marketplace ecosystem over the last year, you've undoubtedly heard of Amazon aggregators. There's now well over 80 companies that have raised over $7 billion to buy individualized Amazon Marketplace businesses. It's unsurprising that with all of this activity, there's going to be some incredible changes that are going to happen. There's going to be bloodshed, and there's going to be some winners. In this video, I break down my top 5 predictions for the Amazon aggregation space. And by the way, if you're an Amazon aggregator, you probably want to cover your ears because some of this stuff may make you want to cry yourself to sleep tonight. Let's go. What is up, guys? My name is Adam, and this is Heist. And today I'm going to be breaking down my predictions on what I believe is going to happen with Amazon aggregators, which are these companies that are buying up individual Amazon businesses, rolling them together to conglomerate a massive enterprise to make a whackload of money. But of course, with all of the melee of activity that's happened in the space over the last year, including more than 80 aggregators getting into the space and $7 billion raised, it's not all going to be good news for everybody involved. What really spawned this video is over the last week, MSNBC put up a deep dive video on the Amazon aggregation space coming out of the industry leading trade show Prosper. So it seems like week after week there's a new headline, a new news story, and a deeper dive from more mainstream players into what's happening in this space. To truly understand this space and how we got here today, we've got to roll this back to 2002. This is when Amazon, for the very first time, looked at how do I get customers more choice on the Amazon platform. And they realized it would be very difficult to stock their warehouses and to present to customers every conceivable product and option that would suit their customers' needs. So they opened up the Amazon Marketplace to what's called third-party sellers. And FBA was born to where basically anybody could enter the platform and start selling. Fast forwarding to today, we've now got a $23 trillion consumer goods marketplace across the entire world, across all different channels. $4 trillion of that actually takes place online via e-commerce, which has really escalated about 60% over the last year. Of that $4 trillion global e-commerce marketplace that's growing double digit every year and has for the last decade, 500 billion of that exists on Amazon marketplaces. 500 billion with a B.
$100 billion.
Now what's crazier about that 500 billion is that the vast majority of that actually is not earned by Amazon themselves selling the product. In fact, north of 60% of that revenue comes from these third-party sellers, which could be me, it could be you, it could be a multi-channel big brand, but it's people that are bringing their products to the platform. And of that north of 60% of the revenue that's coming from third-party sellers, over 100,000 sellers make at least $1 million or more per year on the Amazon platform. And so what we have is probably one of the largest business opportunities that's ever existed and that's ever been democratized in the history of modern commerce. So enter these aggregators who see these 100,000 plus sellers doing $1 million or more, some less, some a lot more than $1 million. And they're coming in to acquire them, roll them up, use their expertise with finance, with capital, and with operating and scaling big businesses. And they're going to grow and escalate those and increase the multiple with which their businesses are worth. So what do I think is going to happen? Let's get into prediction number 1. So if you're an Amazon aggregator, you may not like this first prediction because it is that many of the aggregators are going to fail in the next 2 years. There's just been so much capital and so many players entering the mix that I think it's very conceivable that at least 25% of them just simply won't be able to figure it out. They won't be able to operate, and they won't be able to raise additional capital necessary to keep their businesses sustainable. So to better understand this, let's dive into the math that Amazon aggregators need to pull off in order to be successful long term. So first of all, it's important to understand that the EBITDA of the businesses that they are buying which is typically going to be solopreneurs or smaller enterprises, is typically going to be in the 18 to 25% EBITDA range. Of course, some might be a little bit below that, some might be much more than that, but your general cluster of earnings for most businesses in this space after everything, so after advertising, after OpEx, after software services, is going to be that 18 to 25%. Now, another important math figure for these Amazon aggregators is that they're raising money either using equity or debt. Equity meaning that they don't have to pay anything back, but they're giving up a proportion of their business and a proportion of their cap table. And debt meaning that, hey, I'm going to raise $100 million, but every dollar that I deploy, I've got to pay back to you an interest rate to service that debt. And so the debt service, again, depending on the agreement, experience of the aggregator, the risk of the aggregator, etc. But most are going to be between 8 and 18% debt that they need to pay back on the interest rate. On the low end, it's going to be single digit, but many of these players are going to be playing in that mid double digit range on this spectrum. And so if you take a look at this, just taking out from the debt alone, at a minimum, they've got 7% left if they've got a really high interest rate and their EBITDA is not that great. And then on the high end, if they've either negotiated really good debt service terms or they've got their EBITDA high at the portfolio level, is going to be 17%. So that's the meat on the bone that they have left. And what happens next is all about how they operate the businesses. So I think one thing to keep in mind is that Amazon pay-per-click costs are going up. In their last quarterly earnings report, I think it's something like 60% increase in ad revenue that Amazon is seeing Q1 this year, 2021 versus Q1 2020. So there's no doubt that as more people spill into this space, more money is going to be dumped into growth, and the Amazon advertising costs per brand are going up. I think that the average tacos or total advertising spend on Amazon that most Amazon brands spent that have been acquired is in that 8 to 10% range. I think it's very conceivable that to succeed on Amazon moving forward, it's going to be a 12 to 15% cost of total that you're going to need to spend on Amazon pay-per-click. So I think it's very, low-hanging fruit to say that there's probably going to be a 5% cost burden that's going to be placed on anybody operating in this space moving forward, but certainly the Amazon aggregators. So despite the fact that they bought these businesses at 18 and 25% EBITDA, and then they need to pay off that debt service, which leaves them with 7 to 17%. I think there's going to be an additional 5% cost increase just on ad spend alone, even if they keep everything exactly the same. So that's going to reduce this further to 2 to 12% left is what they're going to have to run the business. Now you've got to think about what does it cost to actually operate these things. So the OpEx of most of these businesses, I think, is going to run somewhere between 2 to 5%. Some are going to be very heavy initially, and I think that a lot of them that are going to actually fail have really put too much resources on their executive team. So they're super, super top heavy, and they've got a tremendous OpEx burden. Versus most of these companies that they're buying, it's usually one entrepreneur, maybe a couple, some VAs, so their cost structure is already really low. So they're going to have 2 to 5% cost structure at least, and some much more than that until they scale and grow. So you have this 2 to 12% money left after all this stuff, assuming you at least keep the business steady, and then you take your final OpEx hit out of this equation. And so what that leaves them with is either negative 3% in the bad case, or on the high case, maybe they've got 10% left. So the really important question, and why I think that many of these will fail, is that they must at least keep the same or grow the portfolio. So if they don't know how to operate these businesses at the portfolio level and grow and scale them, the math doesn't work out for them to have free cash flow. If they don't have free cash flow, people don't want to invest money in them. If they can't invest money, they can't buy more deals, they can't grow, and they're dead in the water. So I think this is the mathematical reality that's going to cause many aggregators to fail in my first prediction. So my second prediction is that the operators are going to be the ones that succeed. And I think anybody on a long enough timeline can figure out how to operate either a single or a portfolio of Amazon brands. But I think the ones that start out with operating talent, either they've operated businesses historically in the space or they've got a fleet of people that are really successful with hands on the ground building businesses, are going to be the ones that figure it out. And to understand why I think operators will succeed, I think it's important to really digest the three key things that are critical in the aggregator flywheel. So the first thing you've got to be able to do is to actually raise capital. And anybody that you've seen come on the scene in any meaningful way has been able to do that. And again, $7 billion raised. Many of these players have raised 9 figures or multi-9 figures in a combination of debt and equity. So that's table stakes, right? If you can't raise capital, you can't accumulate enough money to go out and buy these businesses and scale these businesses. The second thing that you've got to be able to do, and I alluded to it at the start of this, is actually operate them. So obviously the math breaks down super quickly if you can at least maintain the existing growth, but ideally you need to actually grow them to really propel that trajectory. Then you've got to obviously be able to get deal flow, and ideally unique deal flow. So if there aren't businesses to buy and you can't access the sellers that are actually possible to actually acquire, this model breaks down. So you've got to be able to raise capital, operate the businesses so that you can at least maintain and ideally grow them, and then you've got to get deal flow. I think why operating is super critical is that operating is central to those other two things. So if you operate the businesses well, you're going to grow them and successfully scale them, which is going to give the existing sellers that you've purchased businesses from, they're going to be super stoked about it because you're kicking them additional money in their earnouts. They're going to say they had a good experience with you. You didn't destroy their business and brand. That's going to lead to unique deal flow. They're going to tell other people that you're legit. You're going to get a name in the industry as an aggregator that can actually get deals done and successfully grow businesses after the fact. And when you operate them, you get access to new deals. You can go back to your existing or new investors and get reduced debt investment, and you can get equity investment with an increased multiple on what your business is worth. So the operators are going to succeed in this. It's not going to be these top heavy executive teams that come from Goldman Sachs and these big high finance folks. That's going to help them raise capital, but it's not going to help them succeed in this model. So prediction number 3 is that one of the leading aggregators is going to go public either via SPAC or a traditional offering by the end of Q1 2022. So within this next period of time, likely Thrasio, Perch is probably in the mix as well, though they'll probably be about 6 to 12 months after Thrasio is the next big player to go public. But at some point, their exit event and their ability to really return back the capital to their investors at a size when they're growing into the billions of dollars is to exit. And whether you like these big players or don't, and whether you like the aggregation model or don't, as somebody invested in the Amazon marketplace, we all need to be cheerleaders for these companies to successfully go public. And the reason being is that if they're successfully able to go public, which most are probably going to target a 15 to 30x EBITDA exit for them in terms of valuing their market size, it's going to be good for the ecosystem. It's going to validate the model. It's going to inject additional money into the space. It's going to create more money to buy Amazon brands. And it's likely going to increase the multiples that us as Amazon sellers can garner now and in the future. Not only do they need to go public, they also need to maintain and or grow their stock price. So it's one thing to go public, it's another to actually successfully go public. So if they go public and they tank 30%, that's also going to be a universal macro drag on the entire space. But if they can successfully go public, if they can stabilize or grow their stock price, that's going to validate this model where you can come in and buy brands from 2 to 5x on average and exit at 15 to 30x if you go public. That's going to really be good for everybody in the space, from sellers to people investing debt and equity to public markets to the actual aggregators themselves. This would validate the math of success. It is my third prediction. My fourth prediction is that the deal sizes and the minimum EBITDA profit percentages for these acquired businesses is going to go up. If you're an aggregator raising hundreds of millions of dollars, acquiring these $800,000 or $1.2 million businesses is going to be difficult to scale and grow over time. It's effectively the same integration cost to interview, validate, do due diligence, and integrate a business that's doing 5, 10 million as it is one that's doing 1 or 2. So I think the minimum range for us as sellers to have successful exit events and to get multiple qualified buyers is going to require that we have businesses north of $2 million. And the bigger, the better. I think these $5, $10, $20 million plus Amazon businesses are going to be the hot girls at the dance moving forward for these larger aggregators as the space matures. And going back to that math that I covered in the first prediction, where EBITDA ranges are in that 18 to 25% range, I think because costs are going up, I think because multiples are going up, because they've got to service debt, they've got to hire top talent. A lot of that top talent may be stateside, which means that it's more expensive. I think that the profitability of the businesses that are getting acquired is going to need to meet a minimum threshold. And I think it's going to be tremendously difficult to sell your Amazon business if you are less than 20% net earnings at acquisition. Less than 20% net earnings trailing 12 at acquisition. There's simply not enough meat on the bone if you are running a slim margin business to be enticing enough for these aggregators to make their math work and to service the debt and to grow in the way that they need to grow. So deals are going to get bigger, and I think that the appetite for higher margin or higher EBITDA businesses is going to be a second key criteria. And my final prediction is that the competitiveness in this space, with 80 plus aggregators, $7 billion plus being dumped into this, I think that for many of the aggregators to be successful, they're going to need to have niche aggregation strategies and approaches, and they've got to look at non-marketplace deal flow to make everything work and to entice additional investors. So I think it's highly probable we may see things like aggregators focused on, say, health and beauty, or grocery, or other models that maybe make them enticing to, say, a Procter & Gamble. It may make sense for folks to focus on specific customer archetypes. So maybe I want to focus on moms and toys and kids and things in that arena. So I've got clusters of user bases that I can tap into those audiences to scale across the brands. In addition, I think to be unique, if everybody and their mom, 80 plus aggregators, are all kind of going after similar deal flow and they're all Amazon marketplace sellers, I think that's going to be hard for them to have a compelling reason to raise more money. So I think that people are going to be looking at Shopify businesses. They're going to be looking at software companies that will help scale across the aggregated brands that they acquire. All of these unique investment strategies and niche investment strategies, I think, will be critical, especially for the up and coming aggregators to be successful. Now, I said that there was only 5, but I've got a bonus tip or a bonus prediction, and that is we are going to see aggregators get aggregated. I think that there's going to be a handful, again, call it 20 to 25%, I predict over the next couple of years, that will fail in one version or another. So they just literally won't be able to raise money, or they will bury and not be able to operate the brands that they've acquired, so they don't have cash flow and they're going to be sold for scraps. I think there's going to be a second tier of sellers that are going to be really, really successful. It's going to be the big daddies, the ones that are able to substantially raise money and acquire deals and go public. And then I think there's going to be this middle ground of aggregator that is successful. They've been able to operate it, but they're not at the scale and level as the big dogs. And so they're going to be super enticing for the big dogs, either those that are public or about to go public, to either merge and or acquire those aggregators. So I think it's highly likely, and this one's probably going to happen in the next 12 months, where we're going to see smaller to medium-sized aggregators either merge with other up-and-coming and growing aggregators and or get acquired themselves, where somebody's going to come in and scoop up an entire portfolio, a 9-figure portfolio of brands into their operation so that they can continue to scale and grow. So regardless if you agree or disagree, whether you think I'm a genius or an idiot, I hope you enjoyed this. Please stay through to the end. I've got some link offs to my story of selling my business and a masterclass on how I sold my business. If you're ever looking to sell your own business, I've got a link down below to fbaexit.com, which is a free resource where you can get in touch with me and get my advice on how you can sell your business. And if you want to stay in tune with what's actually happening in the space, I've got a Facebook group also called FBA Exit. Would love to see you there. So check out this video, check out the links below. It was great to have you here. Until next week, cheers.